Let's talk markets and what could be another volatile week for stocks. This morning, you're looking at the Dow off by about 260 points, NASDAQ down by 250, the S&P futures off by just over 50. Joining us right now is Alicia Levine. She's head of investment strategy and equities at BNY Wealth. And Alicia, there's a lot of nerves around what we're going to be hearing on Wednesday from the White House. It's a little difficult to try and figure out what comes next, but you have, as at the firm, taken down your expectations for the S&P 500 for the year, I think, to, what is it, 6,000 to 6,400?
Right, we do a range.
6,600 before. And you're also looking for increased odds of a recession. Still only 25%, though, so that's not your base case.
Not our base case right now. I'd say it does change daily, the factors that we have to look at. But a few weeks ago, we looked at essentially some of the announcements that were coming out, the soft data, which continues to deteriorate while the hard data still stays good enough.
So confidence versus what people are actually doing.
Exactly.
You know, actually spending.
Does rock bottom, consumer confidence data really lead to less consumption? Not clear yet. Still, the consumption data is good enough. But we felt we had to raise our odds of a recession just because you're starting to see concern about where's the investment and just not getting the clarity of policy. And so if you get a situation where folks and businesses are frozen waiting for this announcement, you just get lower growth because of then, of course, the pre-buying before tariffs as well. So you have a massive trade deficit, and that goes into numbers as well. So we raise our odds of a recession only to 25% because we're still in the camp that the U.S. can get through this. And that meant we had to lower our S&P estimates, and with it, the target for the S&P. But here we are.
Yeah.
I sent the notes on Friday. We had a lot of announcements over the weekend. I'll say this. The president is talking about tariffs that come in a range of $600 to $700 billion. If that is actually what happens, I think that is going to be very difficult for markets to digest, because then you're talking about 2% of GDP. If it is the lower number, right, if it's at $150 to $200 billion, that is something the U.S. economy can get through and should continue to grow. So April 2nd, it's an event day. We'll have volatility going into the day. And the question is this a clearing event? Because everybody's negative.
Portfolio. A big sell-off.
We've already sold off 10% from the top. It's very hard to find somebody positive on markets right here. Portfolios have been de-risked. The momentum trade has been unwind. And does Wednesday become a clearing event where you can go back in because you have some clarity and you can start analyzing this? The difficulty for markets has been the constant change in message makes it very hard to model. So you're trying to project forward what you think you know. And we, like everybody else, are doing our best to get through the noise here. And that's where we are. So hopefully the second gives us clarity. If the second doesn't give us clarity, then you have to start creating more uncertainty into your models because it's very hard. You'll be frozen.
So what's worse, getting certainty of some really big tariffs, the higher number that you were talking about, 600 billion or so, or having mixed messages that still leave a lot of uncertainty?
I think the uncertainty is worse because then the uncertainty becomes endogenous to the models, right? You can't predict, so you have to
Worse for the models or worse for the economy?
I think it's worse for the economy because you start getting some concern about, activity, investment, hiring. Do I hire? Do I not hire? Do I invest? So I think you need to have clarity. Once you have clarity, then businesses can move forward.
So what do you tell people to do in the next couple of
days?
So,
look, we're in the wealth business. We have taxable clients, and we have fully diversified portfolios. In the past few years, we heard from our clients, why should I be diversified? Why am I in bonds? Why am I in Europe? Why bother? I'll just be a U.S. large cap. So this was the year that diversification went to work in client portfolios. So that's good. But we are telling clients that if you look forward 12 to 18 months, which is really our outlook, because to make changes, our clients will pay taxes on those changes. And so it has to be worth it, right? It has to be worth paying the taxes. We think from here, markets are higher 12 to 18 months. So we're confident there, but we're in a first half that is going to be slower than the second half. And with that is going to come some uncomfortable days. It has not been a great first quarter. It's been very volatile.